Fed's dot plots still serve a useful communications purpose, or do you feel that it might be time to retire it or change it in some fashion?
Well, I think properly understood, it can be useful, but that's been a challenge. You know, I think properly understood to me means looking at what it is and not at what it isn't. And what it is it's an expression of the thinking about individual committee members about appropriate monetary policy and the path of the economy. Remember that we write all that down and we send it in and it gets compiled, but we don't discuss it at the meeting and we don't negotiate a plan. There's no agreement, there's no plan. And I think particularly at inflection points, it's hard to convey the reality, which is that policy is always going to depend on the economic outlook and changes in the economic outlook. And when the economic outlook is changing, the dots they're just not a consideration. We're going to do what we think is the right thing for the economy. And if the dots that we did 6 months ago or 3 months ago don't agree with that, that's not even in the conversation. So it's more, but it can be useful. And I think, but as I said, it's been a challenge. And so I do like to say if you focus too much on the dots, you can miss the broader picture.
Greg Robb from MarketWatch. Chairman Powell, many people seem worried that the framework that you guys are working on is going to be, the results are going to be less rather than more. And people keep coming back and saying asking why you took off like a 4% inflation rate off the table, even when it started. I mean, as you said, if going around the country for all the listen events, I don't think I heard anybody worry about a 4% inflation rate or think that higher inflation rate was going to be a problem. So where does that concern come from? Is it members of Congress that have said this?
No. So let me say we've been working on this all year, and we're just at the stage where we've had a really interesting discussion about the various tools that we have at the October meeting. At this meeting, we talked about the way monetary policy affects different groups in the economy. So we talked about the Fed Listens events and some very interesting research. So we're just getting to the stage where we're looking at conclusions. You know, what do we take away from all this? And those things, many of those things, would wind up as changes, if you will, modifications to the statement of longer-run goals and monetary policy strategy. I think that process will take until the middle of the year. But we want to approach it very thoroughly and very carefully. And that is, in effect, that is our framework document. And I wouldn't prejudge. No one. I believe we will be able to reach a successful conclusion and make meaningful improvements. I do. In terms of 4%, so I think it's premature for people to be saying that this isn't going anywhere. You know, and if you define going anywhere as a 4% inflation target, let me talk about the 4% inflation target. So I'll go back to the point that just saying words is not itself credible. So I think if you said we're raising the inflation target to 4, what would be the effect of that? I mean, where's the credibility in that really? You haven't been able to get it to 2. So I think you need to lower your sights a little bit. I also think is 4%. You'd have to ask the question: is that really, price stability? Is that really price stability? Is that within our legal mandate? I mean, I think it's a fair question. So, I think I'd like for this review to come out with a set of positive results. Meaningful improvements. It doesn't mean it has to solve every problem going forward. We want to have this be a successful exercise where we meaningfully improve our monetary policy framework. These things don't tend to move in a lurchy way. They tend to evolve. But I think, and if we do this then in a few years again and again, things like that, then then at least we're moving in a good direction. And I think we will be. I'm confident we will be.